Hello, everybody. Welcome to the DePINed podcast. I'm your host, Tom Trowbridge. We're excited to bring you interviews with the key founders in the DePIN landscape, investors, and ecosystem partners. This is an exciting time for DePIN, and this year we're going to be meeting even more founders, learning about the projects that they're building, about the traction they're getting, and about the revenue that they're generating. The podcast is brought to you by Fluence. Fluence is building a decentralized compute platform. It's a project I'm a co-founder of and really excited about. So buckle up for this year. Please subscribe to the channel, listen to us on Spotify or Apple. And of course, if you are around any of the large conferences, come to our DePIN Day, where you can meet these founders on the Fluence team in person and hear from all the ecosystem partners as well. So look forward to seeing you in person, and let's get going on this podcast. Hello, everybody. Welcome to the DePIN podcast. I'm your host, Tom Trowbridge. I'm thrilled to be here with Jason, the co-founder and CEO of Daylight. Jason is here for his second appearance on the DePIN podcast. Welcome, Jason.
Thanks for having me, Tom. Excited to be back on the show.
Yeah, and listen, for everyone who doesn't remember, Daylight is a DePIN energy network, basically a decentralized energy platform. And what's pretty exciting about it, and one of the reasons, the catalyst for this particular podcast, is Daylight just recently announced a $75 million funding round. And what's unique about that I think is a third or fourth largest raise ever in DePIN. You kind of got to go back to Helium and Filecoin back, multiple cycles ago in order to get to numbers like that. And so I think, Jason, why don't you kind of explain what that money was? Because some of it was equity, some of it was to build out, I think, other parts of the network. So why don't you kind of let people know what that capital came in to do, and we can kind of unpack Daylight through looking at this raise.
Absolutely. And to kind of, intro Daylight one more time for the audience, Daylight is a decentralized energy network that scales energy capacity to ensure that we have the electricity available to meet all of the needs of kind of the 21st century in the next 100 years. As we think about, the constraints on AI and compute, the constraints on reshoring of industrial capacity, the constraints on robotics and electric vehicles and autonomous fleets, these are not today GPU constrained as many people thought they were. They're today mostly electricity constrained. We're looking at a world where electricity demand is expected to double over the next decade, and we need to find new ways to build the energy capacity to meet all of this new demand coming onto our power grids. Doing it in the traditional centralized way just isn't scalable. It isn't fast enough to meet all of this need. A traditional power plant today comes online in 5 to 7 years after kind of the initial planning period, whereas distributed energy can come online in a matter of weeks or months. And so at Daylight, we are building the infrastructure to scale distributed energy as an active resource for power grids, where they can actively support and help grow the amount of electricity we have available on power grids for the economy. As part of that, in our view, there's two things that need to be done in order to build a decentralized energy network. Number one, you need to incentivize the behavior change for people to come and adopt distributed energy. It is a better product for them. If it's done correctly, it's cheaper and more reliable to run a home or a business off of distributed energy rather than purely buying your electricity from the grid or from a utility or from a retailer in the traditional sense. But there's this huge education and behavior change that needs to go to a customer needs to go under in order to kind of understand what they're getting, understand how this works, and then ultimately become a host of distributed energy infrastructure. And the second component is you need to catalyze an enormous amount of financing to finance this infrastructure. Because the type of infrastructure we're talking about is no longer a $300 IoT box. It is a $30,000 solar and storage system that's professional grade, that's installed on a home or on a business. And so as you think about Daylight, you think about our raise, our network focuses on those two components of the stack. We are launching, in kind of the traditional sense of DePIN, an incentive network, a community-grown distributed energy network that rewards the community directly for coming to the platform, learning about distributed energy, deploying it into their homes, into their business, and helping deploy it further into the community. But we also are raising the capital in order to finance this at scale. And so if you look at our raise, Tom, there's two kind of main components. There's the traditional equity financing component, which I think most people who follow venture deals are familiar with. You raise capital from venture investors. The other major component was a project finance facility that we're using today to finance distributed energy equipment on people's homes through a process we call energy subscriptions. So homeowners today in Daylight no longer have to buy solar and storage. They actually come to the network and they subscribe to Daylight. And what they end up doing is they end up buying this electricity without having to buy the hardware. So the solar and the batteries are installed on their home at no upfront cost to them, and they begin buying the electricity that it produces at a rate that's cheaper than what their local utility is selling them. They get the power built in, the backup power built in order to protect them through power outages, and the network gets distributed energy infrastructure on the network that it can use to actively support power grids with. And so that project finance facility is critical for us to bootstrap the early days of this energy subscription product to finance these at scale and start to deploy several thousand nodes into the network. But from there, we actually plan on turning this into what is, I think, one of the more interesting things happening in DeFi, which are, commodity linked, uncorrelated yield products that can come into DeFi as a new asset class and can also finance an underlying DePIN network. And we're kind of pushing the early boundaries of what's possible here when you start to unite both the DePIN elements and the DeFi elements into one fully on-chain decentralized business model.
That's pretty great. So if I understand that correctly, I mean, backing up for a second, I think the view is I think you mentioned this in the previous podcast, that energy generation is pretty much flat in the US over pick your period, last 50 years, right? And so we have to assume, based on the compute needs, we're going to need vastly more energy over the next 20 years, whatever it is. And we're not going to be able to achieve that in the traditional ways. So pushing out to the edge, effectively making energy more DePIN-like, with consumers participating in investing in infrastructure, is one way to help address that shortage. And to do that, you guys provide the mechanisms for people to basically access and then monetize, and both to access and monetize power that they create or other people's create. And then related to that, you also created sounds like it's a vehicle that makes it easy for people to finance their own energy investments. And that's interesting, because I got to think that you're looking at that as a way, even though it's a big piece of capital, it's a proof of concept in a way, because ultimately I'm guessing the way this really scales, if you have a number of banks or lenders or even purpose designed vehicles who raise capital to deploy these type of resources around, I guess, the US initially, in order to connect to the network. And right, so that you would expect that, I guess, at scale to be hundreds of millions or billions of investment to create this local generation, which then feeds into individuals and a Daylight kind of energy network. Am I getting that right?
That's exactly right. But I think the one nuance there is, we're not looking for a world where, individual banks or lenders are coming in and financing assets on the network. We're looking at a world where the DeFi markets globally are financing the network. So, on one side of the network, we kind of have the physical infrastructure layer, and on the other side of the network, you have the capital markets layer. And that capital markets layer will exist on chain as effectively a tokenized yield product. What we've seen from Athena with the basis trade, what we've seen USDAI starting to pioneer and kind of the GPU lending market, we're bringing that on chain as a new asset class around electricity yields from the underlying physical energy infrastructure network. And our bet and our belief is that verticalizing directly into the capital market stack and having kind of owning the financing layer in DeFi is how you scale to tens of billions of dollars of capital deploying directly into the largest energy network in the world, rather than trying to go around and convince banks and other kind of large traditional lenders to underwrite these assets and have this disparate group of underwriters. When you come from the traditional finance space, you just start to learn how slow and cumbersome that process is. And it becomes quite difficult to actually work with multiple parties, because they're all worried about their subordination. They're all worried about, where do they, stack into this broader network of capital flows. And uniquely, as you look at the history of distributed energy financing, it's largely been a broken market for a long time. No one has underwritten or attempted to underwrite the network value of distributed energy resources. As you go back to our first podcast talking about virtual power plants, now these assets can work together and they can generate revenues from participating directly into the power grid. No one's actually underwritten these and driven the cost of capital lower to the homeowner. Well, all they've done, previously is basically underwrite the value of the hardware itself. And so we're kind of rewriting the rule book of how do you finance distributed energy at scale, and we're opening it up programmatically and globally to individuals, funds, institutions, anyone, uniquely could come in and participate directly in the DeFi protocol and the yields that it produces.
And what type of yields do you expect that? What's your target yield for that?
I'm not entirely sure what I can say or not from like a forward-looking perspective, but you could imagine, in traditional private credit world, you're targeting mid to high teen rate of returns in the traditional private credit space, and I think that's where we're looking.
All right, so it should be competitive with that, and with the security of the power generating asset that not only has that one homeowner to sell to, but whoever else may occupy that home, or whoever else that, I suppose if the homeowner decides not to pay, then that can be then sold to other people, other consumers as well, right?
It can't be sold. The power can't be sold to other consumers because we're not able to route it directly. There's no ability to do this kind of like peer-to-peer market. But we do have kind of a full waterfall of how do you like manage a customer that defaults. Number one, you have very, very high quality underwriting. So our average portfolio currently is a 784 credit score in our portfolio today. So it's very, very high quality homeowner base. Number two is you have a secondary lien, or you have a lien on the equipment itself that prevents the underlying asset, which is the home, from being transferred before everything is due on the assets themselves. So if someone defaults and stops paying,
they can't sell.
You actually have to make the entire subscription whole before you can transfer the home. And then number three is we turn the power off from the system, and so the homeowner goes back to buying electricity from the utility at a much higher rate. Right now, our average subscription rate is about 45% lower than what users are buying from their utility. So 45% savings on day one, which means that your power bill goes back up by 45% if you stop paying daylight. So there's this major opportunity cost to no longer paying your subscription. And then the third is, of course, we own the infrastructure, so it can always be reclaimed if needed.
And how is it different from if you want to go put solar on you? Because a lot of this is solar. I'm guessing you want to put solar on your roof, and a company comes up to you and says, listen, we'll put solar on your roof. You don't have to pay for it. We'll sell you the electricity. It's related. It's a similar model as that, I think, right?
For sure. Similar model. We're the first ones to actually make the battery integrated directly into the system. It's all done at the same exact price. So a traditional solar company will only, again, really sell you electricity directly from the solar panels under that model. If you want a battery, you typically have to pay $100-$150 extra a month for the battery to be installed. At Daylight, we install solar and storage together because we take the view that the network value of these assets are much greater than even just the individual value of these assets. And the battery is what unlocks the ability to generate significantly more revenue for the platform as a network, participating together as a virtual power plant, actively supporting energy grids. So solar provides kind of the fuel to the batteries. The batteries become the network of assets that really support the active energy grid. And the homeowner, as the host, gets the benefit of the cheap energy production and the backup power from the battery to use as long as the network's not using the batteries to support the grid itself.
And so that's what I guess I miss is that the network, the home, supports the grid, which means you're effectively selling into the grid. You're just not selling into a particular other homeowner, but you are selling. If a homeowner, leaves the house and leaves it vacant and moves out, doesn't sell it, then that all of that generation is going into the grid and effectively being sold to other participants, right?
There's a little bit more nuance to what you can and can't do. Something that's not, but the idea is generally that you take these batteries that are deployed at these homes and you make these batteries available to the grid, to the utility, to power traders, whoever could utilize them at times of peak demand. And it's kind of this peer-to-pool model rather than peer-to-peer, where you take all these assets, you anchor them directly onto our protocol's standardized data and validation layer. So you know exactly what exists and how much energy can be delivered to the grid at any point in time from all these nodes. And then when they're dispatched, those batteries will export their capacity to the grid at times of peak stress. And then the network is compensated for delivering all of that electricity at a very high price to the grid itself, just like, going back to the earlier kind of point, just like a big centralized traditional power plant would be paid for delivering that electricity, or a big, massive centralized battery that would, out in the desert somewhere, is paid for delivering the electricity to the grid. We're just doing it in a cheaper and faster way by developing these assets on the edge of the grid. And the byproduct benefit of that is, number one, faster asset development. Number two, our homeowners and our hosts and our network participants actually get a real benefit from this infrastructure getting deployed, which is, again, the significantly cheaper energy bills and the built-in backup power to utilize as long as the network's not utilizing it.
And so this is effectively
you're effectively you're facing off versus the local utility, right? So that's effectively who's buying from you, who's buying from the network and the grid that you develop.
It is an interesting question. And it's kind of this like interesting case study. And you may have heard the term like co-opetition, right? Because users that are coming to the platform and joining the network are actually leaving the traditional utility as their main electric provider, right? But at the same time, they're becoming a reliability and a resiliency resource to the electric utility as it's trying to connect in all these new massive loads from data centers and electric vehicles, and it needs more capacity in order to meet this. And so it's a bit of this kind of this model of like cooperation and competition where, you're competing on certain vectors, but you're also cooperating on certain vectors. And so it is kind of an interesting case study in that sense.
And then as you roll out, you benefit from agreements like per utility, per local market is my guess, versus having a Daylight home spread in, 80 different MSAs. You probably want to have some scale with each utility to make it relevant. It helps with sales marketing, helps with everything, right? So you roll out market by market or utility by utility?
We roll out market by market, and we do it, we do it kind of on a state by state basis. And you really want to, to your point, focus on those footprints in the utilities and focus on the footprints in the ISOs or the power grids themselves. And so we take like a very defined rollout plan of what that looks like. But I think the unique angle that DePIN offers is, number one, our incentive model will really look to kind of think about how do we build local density in. Number two, the unique thing about a DePIN model is we can start to see demand from people looking to join, collaborate, and contribute to the network, and start to see growth in markets where we may not be in just yet. That allows us to prioritize how does the network expand next based on the community engaging in unique areas. A traditional solar distributed energy company would never have this level of market signal to see, hey, we should, open up in Colorado next instead of California. But, we may see that pattern emerge as we start to launch kind of the data network that rewards people for deploying energy data to the broader Daylight network, which helps improve our models, helps improve our forecasting. As we start to see growth on that side of the world, I think that is a great predictor of demand for who's looking for energy subscriptions next. And so the network will be able to roll out in kind of a unique way compared to most traditional companies.
Well, listen, I think we talked about that last time because I think you were kind of cutting edge of a token model that basically, if I remember correctly, allowed investors or even consumers to effectively buy and bet on the next most appropriate market, right? And then even share in some of the potential of that market. Is that right?
That's right. Yeah. We talked about kind of the medallion concept that Dawn has published and that EV3 has promoted quite a bit. We're very interested in that as well. I think, our initial concept will look a little bit more general purpose than the medallion concept. So you can think about, a regional staking methodology where rewards are boosted based on the wisdom of the crowd deploying their stake and pointing it to certain, to your point, utilities, grids, states, zip codes. We actually boil things down similar to helium to hexes in Daylight, right? But as you start to see the network stake on different regions, there'll be economic incentives for people to stake to regions, and that is a great signal of where the network should expand to next, to where governance should approve kind of a new deployment of energy subscriptions.
So many places to go, but let's keep going on the token side for a second. And how else do you see the token model evolving? I don't think you guys have launched a token yet. How do you see rewards, and how do you see kind of the economics besides the sort of the predictor of where to roll out next?
Token networks and token rewards should always be like continuously reviewed and improved. But Daylight has like a unique, if you take a step back and look at the product on the infrastructure side, we have this unique benefit where if you compare it to Helium or to Hive Mapper, both great networks, right? But the only reason really to deploy a B dash cam or to deploy a 5G or IoT hotspot is the economic incentives of growing the broader network. The B doesn't do a whole lot for you as an individual, but it does a whole lot for the network as a whole. And so the network needs to pay quite a bit of economics in the early days in order to build density. Daylight has a kind of a different problem. We have, capital intensity, but there is a huge individual benefit for someone coming and deploying infrastructure into their home. It's cheaper power prices. It's more reliable power, just like we talked about, right? 45% discount. We've got, the backup power built in. And so that's a great reason to come and deploy infrastructure before we even start talking about the network economics and the network incentives. And I think that gives you more of a design space to figure out what actually makes sense in this world. And so as we looked at kind of what interesting DePIN networks are doing, I think what you'll see Daylight will look more like something like WorldCoin than something like Helium in its token distribution model, meaning that net new nodes are rewarded, but there isn't this continuous existing emission stream going directly to nodes that have been connected forever, right? If you look at WorldCoin's model, both the orb operators, the people go around and verify people, and people that are verifying themselves and joining the network are rewarded with kind of these one-time grants that vest over time for their contribution, and those vests could be sped up or slowed down. That is an interesting model for a network where, you want to kind of push someone over the hump, and whether it's the education hump or the kind of customer acquisition hump to join the network. But you don't need to continuously dilute the network by offering them ongoing shares of economics, because it's the only reason for them to stay up and stay connected. And so as we start to get closer to publishing our token economics, I expect you'll see more of this line of thinking, something that looks more like WorldCoin than something that looks kind of like the Helium continuous emission model.
Yeah, fair enough. And I mean, I guess the point you're making is that you're providing enough value for people that there isn't a need for the token to be used. So you could argue you don't even need to give tokens to people off the bat because you're saving so much already. And I'm guessing the type of people you're going after are probably not the most, it's not a crypto native crowd necessarily, right? So there's just homeowners wherever it happens to be that you're rolling the network out, and there may be some token overlap, right? But that's not design. So you're adding a lot of value to people outside of the token versus, pick the original Helium hotspots. There's only token to, investors, buyers, people that's what drove their entire decision to participate in the network. And that's the same with your point with the B or whatever, right? That's exactly what it is. So you have a different concept in that you're providing so much value to people without a token. And then, but that then gets back into...
I might drill down into that just a little bit because you're totally right. And I think Daylight will be the entry point for a lot of these users and customers into the world of crypto and earning crypto and DePIN for the first time, which would be really interesting to see. And that's a whole new UX design experiment for our team to attempt to go and solve, is how do you explain token rewards to these types of people? But if we take a step back, I actually think the bulk of rewards don't necessarily need to go to the homeowner itself because they have this implicit benefit, but it should go to the person that is growing the network in their local communities where Daylight is active. And so you can almost think about people getting compensated from the network, running their own little Daylight franchises, going around and educating their community on why distributed energy matters, why it's better for them, setting up stands at the farmer market and just passing out Daylight promotional material and talking to people about why they join the network, why they should join the network, and building this decentralized sales force to go around and grow the network from the bottom up. That is the behavior you want to reward. Distributed energy has been plagued by really high customer acquisition costs for a very long time. And it's back to this whole concept of kind of predatory financing, a lot of lack of education. And we are willing to bet that a lot of this bottom-up community building effort is actually going to be a totally new way to build trust in the market, to build education into the market, and to help lower the customer acquisition costs that help us scale much faster than the traditional door-knocking sales model. And so that is where you should really think about using token incentives to drive behavior. Is, can you build an army of 500 or 1,000 or 10,000 highly excited, highly invested community members to go around and scale the network from the bottom up and have the opportunity to kind of build their own local businesses in doing so?
That I get. That makes complete sense. It's effectively rewarding a sales force, an ambassador force, whatever you want to call it. And then how would the token be used? What's the demand for the token on the network?
Yep. I think, like most DePIN networks or most DeFi networks, it will be linked as a network token directly to the value that the protocol generates. So the way that we think about this today is, again, if you go back to, we have the physical infrastructure, we have the capital markets layer. Capital markets finances the infrastructure, infrastructure is deployed by the community, it generates revenues from the off-takers, from the virtual power plants, and those revenues flow back as yield back to the capital markets layer. As a network, as a protocol that's bringing all of this marketplace together, both capital, both originators, and that Salesforce, both hosts, it has the ability to take fees on this value flows. And so it'll be very simple. The protocol, just like a kind of a DeFi lending protocol, it will take fees on the yield that's being delivered back to the capital markets layer. All queryable on chain, all viewable on chain. And it's just a very simple protocol fee split. It will take those fees and will route them back to the token and do programmatic buybacks on the token. Those tokens can be withheld in the treasury. They can be used for future incentives. They can be used for capital markets incentives, infrastructure deployment incentives. The protocol can really do as it wishes, as it takes those fees on the yield and uses it to buy back tokens. On top of that, we have, also what we talked about earlier, this kind of regional staking concept where the network will lock tokens and point them to certain regions, and there'll be economic reasons to do so in order to help the network direct its token emissions and its origination volume into markets that make the most sense for the network. But I think simplistically, the right way to think about it is kind of through the classic network token lens of distributed out to participants on all sides of the marketplace, and then as fees are generated in this marketplace, are linked directly and programmatically back to the token.
One thing on that like that, love high by burn is you're well aware. What when I think about the model, when I think about traditional businesses, there's no obviously precise analogy here, but there is often a operating business, and then the financing business is entirely different. And you guys, I think, are fusing those two, right? You're running both of those, and that is. I think at this stage, I think that probably seems necessary because you're the one that understands it the most. But it sounds like also your vision is to keep those two businesses together as opposed to opening up for other capital sources. Did I get that right? Because we back up for a second. That's a unique piece. And you wonder which ultimately becomes bigger, right? Because then you have the whole financing side of it, which is a little bit different than the energy. They're related, right? But you can't grow if the financing doesn't grow. Right. And if your operating business doesn't perform, financing doesn't perform. So they are linked. But is that why you expect them to grow in tandem and to run both?
They absolutely have to grow in tandem. And, at the end of the day, any real distributed energy business can be doing one of three things, right? You can be selling it, you can be installing it, or you can be financing it. That's kind of the value stack. The problem is the value that you lose, the leakage that you lose to the financing, if you don't internalize it yourself, you've given all the power to the financing company. That financing company can say, why would we use Daylight? This other virtual power plant network came to us and they're coming to market and they're subsidized by VC dollars. They're going to give us a pretty sweet deal. So we're going to move all these assets off of Daylight and go to their virtual power plant. It's also harder to enforce economics on how do you actually internalize, how does the protocol internalize the value that it's delivering to the individual on top of what it's delivering as a network to the power grid, right? Because those things are actually one and the same and intrinsically linked, right? The value that the individual gets from cheaper power, from deploying distributed energy, is a market signal that the market needs more distributed energy. And the network is helping bring these things together. And the only way to step in and collect value off of what we're delivering to the individual on top of what we're delivering to the broader power grid is to own the financing layer. And so that's where we, have experimented all across the stack for a number of years. It became very evident to us that, financing and deployment of the infrastructure are totally and inherently linked. And if you want to go out and build the largest distributed energy network, you need to verticalize both into the orchestration, right? So aggregating these assets, standardizing them onto one programmable data layer and making them available to utilities and power traders is like step number one. And then step number two is how do you actually deliver those assets into the market at scale, and you do that with the financing. And so those things, in our opinion, are totally linked together.
I'm not sure. I know another DePIN that does exactly this. I know WeatherXM, you may find this interesting. You may know this, but I think about a third of the stations they sold would not get deployed. People gave up or deployed them wrong. So they said, you know what? How about this? Everyone who wants a station, just give us the money, we'll deploy it, and then we will pay you the rewards from your station. And so there's a similarity there. It's a little bit different because they're not necessarily they're earning just the token rewards, right? So it's sort of a little bit of a tighter link. It's just deploying an infrastructure, but that's a somewhat similar. I'm not sure I'm aware of
I believe
other ones.
the DABA, the Wi-Fi network does something similar. Where
Fair enough.
I believe, and then there's the Fractals team that's coming to market where they're kind of building a crowdsourcing platform for any DePIN that integrates into Fractals. I think they're working primarily with Helium today, and then HiveMapper last month, I believe, maybe 2 months ago, launched a subscription product for the B. So big fleets can subscribe to the B now, and HiveMapper Inc. Or B, I guess BMaps Inc. is their new company name, is financing that hardware on behalf of the fleet deployer. So we're starting to see a lot of experimentation at the edge on like how do you go and scale physical infrastructure in the real world. I actually this is just a broader view that I have, that kind of DePIN 1.0, the classic, launch a token, use it to incentivize hardware deployment, and then kind of aggregate the supply into something useful, is kind of the naive view of how do you build infrastructure. And we had to go through that process to figure out how to do this. But when you look at real, businesses and that are publicly traded, that are building real infrastructure, right? Whether they're electric utilities, whether they're AT&T and Verizon, they have many different types of securities and different types of financial instruments that they use, right? I think AT&T has something like 20 something different types of securities that are available all across, from debt to equity and all across the stack: prefs, mezz, warrants, convertibles. And DePIN today has just tried to been built strictly with, quote me for lack of a better analogy, the protocol's equity, issuing tokens out, and pushing all the complexity out to the miners themselves. And now I think we're starting to see a world where DePINs are saying, hey, there's more value to be captured here, and there's a better network to be built here if the protocol kind of internalizes its full capital market stack, builds it in a traditional, in a novel kind of on-chain way where anybody can participate all across the stack. But this allows much more flexibility, much more scale in how a network can be built than just kind of issuing tokens for plugging in a box.
Listen, I get that. I'd say the only thing I'd comment though on the AT&T side, and I don't know what they are, $50-100 billion business, right? So the scale is wildly different than DePINs. If I were to say, look at the cap structure of the NASDAQ, right?
Yep.
Or the small side of the NASDAQ, which is where DePIN is, you're going to see 100% equity. That's it. So if you compare, I think AT&T is not the right example. It's like early stage, mid stage tech companies are 100% equity. The point, I think, is though that on AT&T is that they're buyers for different type of instruments. And so I think you're driving at a little bit is that there are people who may not want a wildly volatile token upside, but may want a particular yield. And then maybe other, think of, right? And so you sort of the easiest example of this, the most current to our industry, is Michael Saylor's cap structure, right? Where you've got this leverage, this amount of leverage, different yields, right? And so all fair, except they're all targeting traditional investors who have their risk return preferences pretty tightly dialed in versus token buyers. I'm not quite sure how big markets are for different types of yields in the token DeFi ecosystem. And maybe we will find out, and maybe it's all going to grow. I don't know. But that I look forward to that world. I think you're going to be one of the pioneers in it, right? In terms of generating a particular yield and hopefully adding more risk and more yield and less risk and less yield, right? As you try to slice that ever thinner, right?
Right. Well, if you just look at the DeFi markets today, it's not, it's funny. I find, and this was something that I had to explore, coming in to crypto through the DePIN angle, kind of started in DePIN and then expanded into DeFi. And it's actually pretty incredible how much experimentation, and actually I would argue how much participants on that side of the world have dialed in their risk reward and have dialed in exactly where they want to participate in the capital stack. It's like there's this entire country with $300 billion of idle assets sitting there, and it doesn't have any ability to invest in anything today that is uncorrelated. Meaning 99% of the yield streams in DeFi outside of treasury yields are all some form or derivative of kind of crypto native on-chain money market yields that are tightly correlated with the performance of the crypto markets. And so it's only I think it's quite obvious that those stable coins, the 300 billion of stable coins that exist today, the $1 trillion of stable coins that will exist in the next, call it 3 to 5 years, are going to be looking for novel, uncorrelated yield streams so they could build a diversified yield base for the assets that are sitting on chain. And you're going to want things like energy yields. You're going to want things like GPU yields. You're going to want yields from traditional kind of corporate structures. And so, I think that is just a bet that we're excited to make, and we're starting to see the market wake up to. I don't know if you saw Framework and Layer Zero and Sky, formerly MakerDAO, launched a incubator where Sky is going to provide several $1 billion of liquidity towards for new innovators that are building novel yield-backed kind of synthetic dollar or stablecoin products in order to bring these new yield streams on chain. And so the market is starting to get really excited about this. And I expect this to be one of the more interesting kind of metas of 2026 is what are the novel yield streams that will be packaged into kind of tokenized structured products and delivered on chain for stablecoin investors, starting next year. And then kind of on from there, we'll see much more experimentation.
Listen, I get all that, except for stable coins in the US have to have treasuries, right? That's the rules. They have to be 100% in treasuries if you're going to be a USD listed, build stable coin, right? So they're pretty limited in what they can buy.
Well, you don't want to take an actual stablecoin and back it with something that's not a treasury. What you want to do is just like I have a dollar, right? I can't make this dollar backed by something other than the guarantee of the U.S. government, but I can deploy this dollar,
deploy the dollar, and earn a yield there. Fair enough. So people that own stable coins, not the stable coin companies.
What you're looking for is dollar denominated on chain products.
Yeah, that I grasp for sure, which is uncorrelated to the crypto market. That makes a ton of sense. Yeah. And then going back to energy. Because a lot of what you talked about, I think you mentioned the importance of the battery in what you're offering. And, you may have heard or not, you probably hear this regularly, but, Elon was out there talking on a podcast recently about the sun being all the energy in the universe, et cetera, and that just installing batteries would double the effective supply in the US. And so a lot of what you're talking about dovetails precisely with that concept where you can increase generation, great, but by adding a battery, you're multiplying the effectiveness of that generation. So you're sort of doubling it. When you add generation and you add a battery, you're really doubling the sort of effective generation that you're adding. Is that a way to look at it?
That's exactly right. Batteries are like time machines for electricity, right? When you have solar panels installed on the roof of a home, they can only generate electricity when the sun is shining and they're kind of producing at max capacity, right? No matter how hard we try, we haven't found a solution to really have them produce electricity at night, right? It's reliable. It's not reliable to try to solve that problem, right? Batteries, however, can store excess generation and can deliver it to the home or to the grid whenever either party needs it because it's stored and it's available for use at any point in time. And so when you decouple the timing of generation from the timing of delivery of electricity to the power grid, you can be rewarded much more for delivering electricity, when it's needed compared to when it was actually generated. And that's kind of the view of why batteries are so valuable. To Elon's point, I think the point he was trying to make was, power grids today are sized for peak demand, not average demand. So peak demand is, maybe it's 1.5 or 2 times what the average demand is. But the reason they're sized for peak demand is because if we aren't able to meet the 1 minute of the 1 hour of the 1 day a year that electricity demand is at its highest, then the entire grid will actually collapse. And so we have all of this underutilized capacity. If you think about like 00 and what they're doing, right? All this underutilized fiber capacity, same thing with power grids. You have all this underutilized electricity capacity. I think Elon's point was we could build a ton more generation that is producing at the peak capacity of the grid at all times and just storing it in batteries and allow the batteries to be the buyers of that electricity and then deliver it when the grid needs it. It'd be compensated for delivering that electricity when it needs it, kind of as an electricity sponge.
Interesting. Yeah. And the other point he was making, which it sounds like you guys, you mentioned, individual contributors, moving generation to the edge. You're really talking about solar. And his point was solar is really the future. Sounds like that's what you're not talking about people, doing geothermal wells in their home or putting in, natural gas wells or anything, right? This is just to be super clear. This is about generally rooftop solar, I'm going to guess. And I'm also going to guess that price point now makes this much more effective than if you had launched daylight, I don't know, 5 years ago. Like a whole bunch of things had to come together to make this effective, but the efficiency and effectiveness of solar probably has had to hit some milestone in order to be, cost effective. Is that right also?
Yeah, I mean, generally the cost of solar has declined by 90% over the last decade. The cost of batteries have declined by 90% over the last decade. That is a huge input into this. But to be clear, we would use other technologies if there was a way to build distributed energy that made more sense than using solar or batteries, right? If there was a tiny coal plant that we could deploy into every home in their backyard, we would, but there is no, kind of tiny coal plant that would be pleasant for a homeowner to deploy into their backyard, right? And so solar and storage is simply the cheapest and fastest way to deliver electricity at the edge of power grids. Maybe there's a world where, small modular reactors on the nuclear side come to market, or there's some kind of growth, to your point, on the geothermal side, but it's not enough for them to catch up to the price point of where solar and batteries are today. And they need to catch up to where solar and batteries will be in 5 years when those technologies actually come to market. And I expect solar and batteries will go down another 90% in price over those 5 years. So I think for the foreseeable future, if you're building distributed energy, it's going to be solar and batteries. It's not going to be geothermal. It's not going to be SMRs. It's not going to be natural gas.
Help us understand the potential scale here. I mean, with your raise, you get to, I don't know how you metricize it. Is it number of homes? Is it number of kilowatt hours, or how you think about that? And then where you think, 3-5 years, what would make you happy? Help us sort of give some rough kind of universe to be thinking about here in terms of scale.
Absolutely. So the raise that we're doing today is going to deliver several thousand homes of energy subscriptions to the network. Our North Star, though, is to be deploying billions of dollars of capital every year directly into distributed energy that is on the network and actively supporting energy grids. And so, as we think about kind of what our North Star is, 1 million homes in 5 years is what we're looking to deploy to. That would be about 10 gigawatts of electricity generation, more than that of gigawatt hours of storage. And we think that is a massive, massive success for the network. We're, one of the largest energy developers in the world at that pace. And so that's kind of our North Star, is going from several thousand homes with initial capital over the course of several months to millions of homes over the course of several years.
Big ambitions. I mean, that would be terrific. And if you were generating, you said 10 gigawatts, is that right? And
Right.
so what that effectively is, from our earlier point, is that'd be 10 gigawatts of new generation plus a comparable amount of storage, I'm guessing, right?
Correct.
So it's effectively a 40 gigawatt kind of contribution or net new to the grid, right?
That's right. Yep. If we think about every 100,000 homes is about a gigawatt of new generation, and could be, around the ballpark of 20 to 30, depending on the average battery we install, 20 to 30 gigawatt hours of storage, or 2 to 3 gigawatt hours of storage.
I mean, I got to think that local governments and communities would be pretty excited to have this. Even new developments, or you get a new development side, you sort of scale even faster. But I got to think local communities would be pretty excited to be able to add this to their development plan and to their communities.
I certainly hope so. We're starting to see this interesting kind of lashing out against data center developments in markets today. There was 2 major data centers. I think at least one was canceled because it was not going to get the approval from the city council, because so many people in the local community were up in arms about the potential increase in electricity costs from the development of these data centers. And so if the world wants to, get to AGI, and we want to deploy compute at scale, and we want to deploy Tesla's robot armies, we want to deploy autonomous vehicle fleets, we want to deglobalize and bring manufacturing and industrialization back to developed countries like the US, it's a significant increase on electricity demand. And we're starting to already see communities push back on all of these major developments because specifically of the potential increase in their electricity prices. So I expect people will be looking for alternatives increasingly over the next few years as power prices continue to rise faster than inflation, and as reliability continues to go down. And then interesting new models like Daylight building these new interesting distributed electric utilities of the future present a very, very compelling option.
When do you think what's your plan for a token? I mean, it sounds like you have thought about that. You're still working on it. Are you waiting for a particular milestone in terms of deployment? What's sort of driving that timing?
That's right. Yeah, we're looking for, both, number one, starting to scale kind of DeFi native capital formation behind the initial $60 million of project finance that we've raised. Also deployments into the network, right? We'd love to hit several thousand deployments of homes and energy subscriptions or line of sight to those, where the network is generating, close to tens of millions of dollars of revenue per year before the token launches. And I think that would be an incredibly exciting outcome where the token is launched not as the initial primary bootstrapping mechanism, but as the one to N massive scaling mechanism. That's right.
And that would be what, mid next year?
I think that's a reasonable time frame.
Fair enough. Super exciting. Well, Jason, really terrific update. Congrats again on the raise. How do people follow you? For those that don't know Daylight, how they follow you, how they try to convince you to make the offering in their community? How do they follow you in Daylight?
Absolutely. So they can follow us on X and Twitter at DaylightEnergy_. Join the Discord. We've got an active Discord community. We've launched something called the Sunny Side, which is the ambassador program. Back to kind of the model we were talking about, Tom, where we're going to incentivize community members to go out and help us scale in their local communities. The Sunny Side applications are open. Our team is reviewing those applications, starting to work hand in hand with those Sunnysiders that join and giving them the education and the tools needed in order to go out and start participating directly in the growth of the network. And then we'll be relaunching actually the Daylight app in the coming weeks, which will be exciting. And then we'll be launching again the DeFi products in the coming months. So there's a lot to do and a lot to follow along with. But the Twitter or X is the best way to stay in touch with us.
Well, so the big update here for me was this whole DeFi integration, the DeFi component of what you're doing. I think that is super fascinating, and it's the largest kind of DePIN DeFi overlap that I think exists, and that's going to be fascinating to see that yield product out there, and for anyone to be able to buy tokens on it. Right, it'll be a token. So your token won't be trading, but the DeFi tranche should be out there for people to buy and earn yield on, right?
That's right. Yep. And to your point, it is kind of one of the earliest experimentations here, but what I see it as is kind of closing the loop on a totally decentralized on-chain business model that's scaling infrastructure in the real world. And that'll be incredibly exciting to see scale over the next year.
Excellent. Well, I definitely want to have you back on for a third time when we can talk about the DeFi model and how that integrates with DePIN, because that's a whole story and a whole channel by itself. So congratulations on the success, and can't wait to have you back on.
Thanks so much.
So I think the token that's coming up is going to be the token that is the yield product for the 65 million you raised. It's going to be deployed and earning a yield based on the underlying assets. When do you expect that to launch, Jason?
That's right. So our yield product will be known as Grid, kind of a play on power grids, but it is this energy yield product that will be delivering as a tokenized structured product to the DeFi markets. And so our plan today is that will be slated to launch in January, and we'll run kind of an exciting incentive campaign to start to scale the DeFi activity to help it deploy and integrate deeply with DeFi ecosystems, whether it's DEXs, lending markets, interest rate markets, and build truly like an interesting new novel collateral asset for use in DeFi. But we're planning for that to come to market in January.
And so that Grid token, just so we're clear, that's around the $65 million worth of raise that's going to be earning some yield. So you're effectively tokenizing that raise, and then the yield will be paid as those homes are deploy solar and start paying, right? So the yield will sort of go up and then sort of level off as that deployment matures. Is that the way to think about it?
That's right. We're not tokenizing that capital directly, but you can think about this as infrastructure capital that is financing those assets, just like that initial $60 million is financing those assets. So we're building kind of a lending market where projects can be tokenized and deposited directly into that, and the capital can be drawn down to finance those projects.
So it's additional capital. It's not just that 65. Capital. It's additional capital. That 65 will earn its yield, its own thing. It gets it started. And this is a different piece to access the DeFi marketplace.
Exactly.
And so sort of evergreen then, I suppose.
Exactly.
Really interesting. Well, it definitely can't, it will be really exciting to see that launch. It's going to be a busy holiday and a busy January for you. How do people track that? How do they, subscribe if they want, or how do they follow that?
So that will be at, we're really kind of calling this financing protocol DeFi. And so they'll be at defi.com, where we'll have kind of all of our metrics and stats, and also have the front end for interacting with the app itself.
Terrific. Well, go to DeFi. I'm certainly going to go to DeFi and see what I can learn about it.
Amazing.
The DePINed podcast, the place where we explore real world use cases unlocked by crypto. That's all for today. Thanks for watching to the end. If you enjoyed this episode, please help us grow. Add a like, add a comment. And of course, if you have anyone you think we should be talking to or have on this podcast, either leave a comment there or reach out. But thanks for watching, and we'll see you next week.